Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The growth rate of fresh investments in new projects by the private sector is one of the most credible and dependable yardsticks to judge the state of the actual economy in any country. A growth in such investments shows rising consumer demand and GDP growth in the country. It shows the confidence to invest and the willingness to take risks out of a sense of optimism. It shows the confidence of the banks to lend and of the investors to invest. It indicates lucrative and profitable opportunities to invest. It shows supportive government policies. It indicates an improved ease of doing business in the country. It shows better levels of employment and livelihood. It also shows availability of infrastructure, and it shows overall consumer and corporate confidence, which gives rise to fresh demand and new markets and thus new investments. And when new project investments languish or they are stagnant, it either means that consumer income and demand is falling, or it means that confidence in the overall system is missing, or that the investor and the corporate has better and much more lucrative and safer and profitable opportunities to invest, or that there is lots of unutilized capacity in the sector, in the industry and in the country, or it could be a combination of all these reasons together. In the case of India, where investments in fresh projects have been decelerating and languishing since the past few years, all of these factors which deter fresh investments have been at play, which is falling consumer demand, massive unutilized capacities in the country, continued unwillingness of banks to lend, chronic reluctance of corporates to invest, a huge infrastructure deficit, rampant red tapeism and corruption, oppressive regulations and compliance requirements, poor ease of doing business, and better investment opportunities in other parts of the world as compared to India. It explains why the private sector has been sitting on the fence in India, loaded with money, but reluctant to take risks and invest its capital in new projects or for the purpose of fresh build-up of capacity in its own industry. Due to depleted household incomes, consumer spending has fallen, and so has capacity utilization by corporates, which has averaged at about just 65 to 70% in India in the recent years. The obvious reality is that no corporate will build up additional capacity if its existing capacity lies idle, and that has been the case of India. Apart from idle capacity, the fact also is that factors like delays in land acquisition, overbearing laws, challenges of environmental clearances, labor issues, etc., too have been deterrents to fresh investments by corporates in India, despite sitting on record balances of cash at the moment. While that being so, corporates are however willing to deploy their cash in the takeover of existing companies or even for overseas takeovers rather than risk their capital to the uncertainties of setting up new greenfield projects in the country. Such investments for takeovers are far more safer and profitable for them with lesser uncertainty, and the lenders too are readily willing to fund these kind of acquisitions. This is evident from two cases which have been hitting the headlines in India in recent days. The first case is that of Wholesome Switzerland, which has put its controlling stakes in Ambuja Cement and ACC on the block as per its global strategy to exit from its non-core businesses worldwide. It is selling such investments and factories not just in India but also in Brazil and Russia at the moment. Wholesome owns a 63.1% equity stake in Ambuja Cement, which in turn owns 50.05% of the capital of ACC. Wholesome owns another 4.48% equity stake in ACC by way of direct ownership. These investments are for sale, and anyone who buys them will own two major cement companies of India, which is ACC and Ambuja Cement, which have a combined installed capacity to manufacture 66 million tons per annum of cement out of India's total installed capacity of 550 million tons per annum. The expected price tag for this investment or acquisition is upwards of $10 billion, and there are already numerous players in the fray, headed by the ever-hungry and mysteriously ever-cash-rich Adani Group, which is keen to get into the cement business and become a major player from day one itself if it manages to acquire the wholesome stake in the two cement companies, which is ACC and Ambuja Cements. Adani is said to have tied up the required funds with the likes of Barclays, Standard Chartered Bank, Deutsche Bank, and even local banks like Axis Bank and ICICI Bank are eager to chip in and provided the funds to take over the wholesome stake in ACC and Ambuja Cements. The banks are said to be willing to provide up to $5.5 billion to the Adanis for their takeover bid. The other bidders in the fray, apart from the Adanis, are GSW, Dalmia Cement, and the market leader Ultratech Cement of the Aditya Birla Group. Unlike Adani, which is a relatively new player in the cement business, the others are existing players with sizable capacities already. While Ultratech Cement has an installed capacity of 120 million tons per annum, that of Dalmia Cement, which is one of the oldest cement companies in the country, is about 35 million tons per annum, and that of JSW is about 14 million tons per annum, all major cement players of India. While it cannot be denied that the takeover of ACC and Ambuja Cement is a rare opportunity for these companies, which will give them ready, huge installed capacity, ready market share, and economies of scale and pricing power. Yet, the other pertinent reality is that by buying an existing business, they are obviating and bypassing all the risks and uncertainties of setting up new projects in India, as in the case of the Adani Group, which has been planning to set up a greenfield cement manufacturing project of 5 million tons per annum, one each in Gujarat and one in Maharashtra. And also in the case of GSW, which proposes to expand its capacity from 14 million tons per annum to 25 million tons per annum by financial year 2024 by investing in greenfield projects. If they buy the wholesome stake, they will not need to undertake the uncertainties and risks of setting up new projects. The point to note here is that by paying over $10 billion, say almost 80,000 crore rupees to Wholesome, no additional or fresh manufacturing capacity or production assets will be added to the productive capacity of India, and no additional productive assets will be created or built by this investment of 80,000 crores in the country. It is the case of an existing project manufacturing capacity changing hands with no incremental addition to India's manufacturing asset base, which would have taken place had the private sector invested this huge sum of 80,000 crores in the setup of a new plant in India. It merely shows the unwillingness of corporates to risk capital in new projects and build additional capacity in the country. The other instance of reluctance to invest in new projects in India by our own domestic companies and preferring to look at overseas opportunities of investment is that of the proposed multi-billion-dollar acquisition by Reliance of the British pharmacy chain Walgreens Boots Alliance, which has over 2,000 pharmacy stores in the UK, which gets 45% of its revenues from the National Health Scheme of the British government, and which also has smaller operations in Ireland, Norway, Netherlands, and Thailand. Reliance is said to have teamed up with Apollo Global, a huge private equity player, proposing to invest about $10 billion in its quest to take over Walgreens Boots. This is yet another case of an Indian company willing to invest a huge sum of money, but not in a fresh project in India. And the investment of US dollars 10 billion by Reliance in this case will create no new assets or additional productive capacity or business here. It has now been a few years of fresh investments and capacity build-up being at a standstill in India. It has also been a few years of continuous falling consumer spending in India, which began from the disastrous demonetization in November 2016. both have been falling, investments as well as consumer spending. Due to that, and due to an era of rising unemployment and falling livelihoods in India, capacity utilization across industries has remained stagnant at just about 65 to 70%, which has dissuaded the corporates from investing and building up new capacities in the country. The sheer difficulties in acquiring land itself has actually spurred the likes of Tata Steel to buy the sick fraud units like Bhushan Steel. It is a massive challenge to acquire large chunks of land in the country, and thus, instead of facing years of delay in buying land, it has preferred to buy Bhushan Steel, which had a lot of surplus land, and thus it avoided risking the uncertainty of setting up new projects in the country. A recent survey of Business Standard says that a pickup in private capital expenditure is expected, with about 50% of the respondent CEOs saying that with consumer demand expected to pick up in the current financial year, they expect to increase their capital expenditure by 25% during the current financial year. That coincides with the Reserve Bank too forecasting that investment was likely to gain traction with an improvement in business confidence among the investors, and also because of a pickup in bank credit and continuing support from the government's capital expenditure on roads and highways. That's what the Reserve Bank thinks. We think that with the Ukraine war yet to end and India's growth yet to pick up, afflicted by inflation and unemployment, we do not share Reserve Bank's optimism and hope, and are of the opinion that financial year 2024 is the earliest when there will be a visible and sustained takeoff of private capital expenditure in India. Till then, cash-rich corporates like Reliance are not going to sit on idle cash. They will look out for overseas investment opportunities or for takeover of existing Indian companies, and they are certainly not going to start investing in greenfield projects, in building up fresh capacity in the country till things really improve to their satisfaction. This is Akhilesh Bhargava signing off till we meet again.